Hello, I am Siddharth from Bajaj Mutual Fund. Welcome to our fixed income market update. Over the last few months, we have framed markets around three variables: oil, external balances, and policy response. This month, the framework becomes even more important because the monetary policy has made a very clear choice. It has not responded to currency pressures through rates, but instead has gone all in, attracting dollar inflows. Let me start with global environment, which remains challenging. Oil prices are elevated, global trade is slowing, and financial conditions remain uncertain. For India, this means persistent external pressures, weaker BOP, and tighter liquidity. So the starting point for policy is already constrained. On domestic side, the trade-off is becoming clearer. Growth has been revised downwards to 6.6%. Inflation has been revised upwards to around 5.1%. So we are moving into a phase of slower growth and rising inflation risk, driven by not only higher oil prices, but weather risk and second round effects, which are still to come. But the real constraint today is external sector. The current account deficit is widening, capital flows are volatile, and rupee is under pressure. Now at first glance, the latest MPC outcome looks like a standard pause. Rates are unchanged, stance is unchanged, but beneath that, the strategy has clearly shifted. RBI has chosen flows over the rates. It is not defending the currency through higher interest rate, but it is engineering the capital inflows. The policy package is very targeted. NRI deposit incentives, external borrowing hedging support to PSUs, tax easing for foreign investors, expansion of global access to G-Sec market. Put together, the idea is to bring in dollars rather than tightening the system. So where does this leave rates? In short, near term, the pause continues. Medium term, the tightening bias still remains. Market will still price in 75 basis of hikes over 12 months versus higher earlier expectations, as INR stress has increasingly been addressed by flow-based measures. But the important shift is this: future rates move will be driven by inflation, not by currency pressure. For rates market, the clearest takeaway is the short end is the biggest winner. As FCNR flow replace bank CD issuances, PSU borrowings move offshore, other dollar flows hit domestic markets, liquidity will rise. We expect a rally in short duration assets and in segments like bank CDs, CPs, sub 5-year AAA PSU bonds and corporate bonds. So in near term, flows may move into money markets and short duration funds too. This will lead to stronger carry opportunities and continued spread compression. Long end, however, is different. It remains linked to global inflation, geopolitics, index inclusion timing. But importantly, in this segment, a large part of risk is already priced in. To summarize, for fixed income, the short end is the strongest opportunity. Carry trades in short to medium term are clearly supported. Long end stable but externally driven. Thank you for watching and see you next month.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.